Hello, and welcome to the End of the Chain. I'm your host, Samuel McCulloch, and this week I'm joined by Philip Gradwell, who is the Chief Economist for Chainalysis. I actually just learned how to say that in the call that I had at the beginning with Philip, and Chainalysis does transactional surveillance of cryptocurrencies. And so they monitor your BTC, they monitor your ETH, and they are keeping detailed records of money flows in and out of service providers, such as exchanges, so that they can have a clear picture of what's going on with certain accounts and wallets and other information that's contained within all the metadata on the Bitcoin and Ethereum network. So really enjoyed this. I had a great time talking with Philip, and he was a wonderful guest. So I hope you enjoy this, and let's hop into the episode. All right, I want to welcome Philip Gradwell onto the podcast. Welcome to the End of the Chain, Philip.
Hi, thanks for having me here.
Yeah, so Philip is the Chief Economist for Chainalysis, which is a blockchain analysis company, right? They essentially work with different service providers and governments and other people who need the compliance and investigation software that they've created to monitor on-chain transactions and how they are tied in with the real world. So, Philip, again, welcome. Maybe you could just tell us quickly what a chief economist does for Chainalysis.
Yeah, so I think a chief economist is almost one of the stranger roles in a company like Chainalysis, because, as you said, the core of the business is about understanding transactions on a blockchain and how they link to like the real world entities such as the exchanges and so on, and that's largely used for law enforcement and compliance purposes. But if you look at a blockchain, it's actually a complete economy. So, it's sort of different individuals sending, money between themselves and interacting with other services, be that like a darknet market or somewhere to buy some kind of novelty socks or, an exchange to go trade on. And so I'm at Chainalysis to look at our data, from that perspective, to try and understand the crypto economy and, to take the macro view and describe the trends about what we see in usage patterns for, Bitcoin, Ethereum, all the different cryptocurrencies that we cover.
Because Chainalysis covers a lot, don't they? I mean, they work with some of the largest exchanges in the crypto space, and they also you guys are providing services for a lot of people because compliance is an integral part of every business's, at least real world businesses, operations. And employing a company like Chainalysis is extremely important to make sure that no company is taking in any funds which would be connected to any sort of criminal activity, terrorist activity, or anything else. I've always been interested in Chainalysis because I come from an intelligence background, like we were talking about beforehand, and the gobs of metadata that exist, or at least can be connected with Bitcoin, is both extremely interesting and also, it scares me. It scares me in one respect, right? Because if you think about the amount of data collection, I know you guys are a private company, but if you're able to pair the analytics that you guys have with something that a government might have in their, I guess, whole scale intelligence gathering operations, it becomes a lot more different of a picture, right? But on the private side, when you're just providing compliance, it may be a little bit different. So I guess maybe you can touch on what the scope of what you guys are looking for at Chainalysis, and why it may not be as, I guess, off kilter or I don't know.
Yeah, there's something that makes people feel a little uneasy about it. So maybe I should kind of
yeah.
talk through that and try and kind of, almost get specific on what it is that we look at. So yeah, blockchains are databases, and at the heart, they're a database that says like this address transacts with this address. And actually, the core thing that we do is we map sets of addresses to entities, because any individual can have as many addresses as they want. And indeed, any business can have as many addresses as they want. So like when I say entity, I'm really referring to, individuals, but we don't know the name of, but we can tell that they're, a single sort of person. And then the businesses are things like the exchanges. So you've got to map, addresses to entities, and then you've got to say, okay, well, this entity looks like a business, and we don't actually, identify this set of addresses that belongs to an individual, or say like Philip. We leave that unlabeled, but we provide the ability for our customers to essentially follow the flow of funds from those wallets into the services. So that's the kind of core data set. And then you mentioned the metadata that's on the blockchain. That's like a little bit limited actually. There's things like what address type, is this address? There are certain transaction features. And then there's the sort of peer-to-peer network where the transactions are broadcast. But because of the way that the broadcast happens, it's actually useful than you might think. So really the core data set is actually this mapping from addresses to entities, and then for the businesses, mapping those entities to like a real world thing like Binance.
Right. So I mean, coming away from so I know that the choke points really are the services, right? So if there's any non-compliant or criminal funds, right, they can be stopped at the service level when money is trying to be switched into some sort of fiat currency and moved into a bank or moved away from the blockchain. That's kind of where governments like to, I mean, it's where they do most of their work, right? Because nobody can stop any Bitcoin transactions, and nobody can prevent anyone from sending one Bitcoin to another wallet. So the only power that can be used is at the exchange level. But I think that's fine. I mean, there's no getting around that. Let me go on a little different tangent then. Let's say that. I mean, is there anything? If I'm a business, right, and I'm doing most of my business on chain, whether it's on Bitcoin or Ethereum or anything else, that is public identifiable information that can be used by investors or other companies to build a data profile of my business. Is that something that we should be worried about, in that as a business you're putting out what may be confidential or non-public information onto a blockchain that you would like to keep, or at least something you would like to keep confidential, and that these data flows could be used against your company if I don't know, like by a competitor or something else?
Yeah. So and I should say, I do think, for example, Bitcoin is too transparent. You don't even need to make the example you gave. It's simpler than that. It's like, right, if I make a transaction with someone, they can see how much Bitcoin I've got. And you're like, that, what if I was getting paid in Bitcoin? Or even if that's just where I put most of my wealth? Like, as a society, the one thing that we haven't really started sharing yet is our financial information. I mean, we've shared almost everything else on Facebook, but there seems to have been like a taboo about going into the financial side. And Bitcoin, it almost inadvertently breaks that down. And I think we see greater privacy options in cryptocurrencies, or maybe we get comfortable with that. That I'm not sure about. But just the final thing I'll say on that is, it's actually, there's a really almost live debate around that, which is around proof of reserves. So people were saying, look, we actually want exchanges to reveal, how much crypto they hold, because that will make us trust, that they actually, are operating, one-to-one reserve ratio. They haven't run off with my Bitcoin. And I think the exchanges, they have a number of reasons why they don't want to do it. But I think one of them is this kind of nervousness about revealing how big their business is.
But I don't like the proof of reserves thing, right? Because it's disingenuous about how much business is actually being done inside the exchange. Because you're an economist, right? And you should really, I think on one hand, you probably love that everything is transparent and that you have this open data set that you can go and look and run studies on and perform all of the analytics that you're doing, right? For like a business, right? As soon as you take a deposit and then lend out against it, you've created more Bitcoin. It's like just base currency or a claim to that currency. You've created more money. So even though there may be a proof of reserves at an exchange, you don't know what their lending book looks like. You don't know what their ratio of reserves to loans are. And so, without understanding the loan structure and the derivative structure for each exchange, this proof of reserves is meaningless.
I agree, but I think it can still give you some helpful ratios. Like, we, for example, looked at the ratio of reported spot trades to inflows into exchanges. And, it kind of varies between 5 and 15 Bitcoin being traded for every one that comes in. But then there were some exchanges that had ratios of like 100 or 1,000 Bitcoin traded for every Bitcoin that was flowing in. And there you're like, I'm not so sure that trade data makes sense. Perhaps something funny is going on. So like it's a way of verifying what's going on. But I agree, getting really precise. And I think there's actually like a general lesson about blockchain analytics is people think it has much more precision than it actually has. I've spent now like over 2 years at Chainalysis, and I've spent a lot of that time doing quite fundamental research to make sure that, when we say something, we can say it with certainty, and we know why we might be wrong. We know why it might be an upper bound or a lower bound. Like the data set's noisier than people think. So it's not quite this kind of God view of the crypto economy. It takes a lot of work to get anywhere close to that. And even then, like the question I ask myself every day is, how do I know that I'm wrong? Because most of the time you are,
Yeah, I mean, again, it mostly comes back to the service providers, right? In that there was zero transparency really in 2018 and 17 into what was happening on these exchanges, and you saw huge amounts of wash trading and manipulation by these businesses to essentially deceive people and to think that their volumes were higher or that they were essentially it came down to volume, right? That they had volume and liquidity, and that people should come move their funds to those exchanges to trade with. And so implementing different like on-chain analytics, like what you're doing, to actually see if these companies are providing the services or have the deposits, or deposits are in line with how much actual regulated exchanges are functioning. It's a very important part of providing transparency, right? You must really like that all of this data is public, right?
I mean, it's the reason I joined Chainalysis in a way. So like it is fascinating from like that economics perspective. If Bitcoin achieves nothing else, it will provide like the academic research community with years worth of papers. There's so many different interesting study questions, not all of them that we kind of can do internally because we're still a company, but it's a bit of a privilege to get to at least try and help shape that. But yeah, but the thing that's really interesting from the kind of crypto economic side is, I mentioned earlier, you've got, the address data set is your kind of fundamental data set. And then you have to do all this work to understand which addresses belong to which entities. And so it's a bit like you get to look at a complete economy, but it's like you've got blurry vision because you're never sure if what you're seeing is because actually there's these addresses that should belong to an entity, or if they're actually belong to another entity. So, on the one hand, I think when I literally have a whiteboard of my first week at Chainalysis of like a whole bunch of metrics that we wanted to do. And, it was only about 18 months later after we'd done a whole lot of research, I was like, I can finally make these charts, because we had to do a lot of research to essentially solve that problem of things being slightly out of focus whenever you're doing the analysis. So it's this double-edged sword. You've got loads of data, but the interpretation of it is actually more complicated than it is if you're doing, normal economics on the fiat system, because there the entities are very crisp, as it were. You know that this bank account belongs to a person, and it doesn't belong to someone else.
Right. And if you're working in the UK, it's the Exchequer. Exchequer?
Yeah.
Yeah, Exchequer. And if you're working at the Exchequer, you have databases where you can go into and see all the accounts and all the account information and perform whatever study you need to. Yeah. What are some of the biggest challenges facing on-chain economic studies in 2020 that have yet to be solved or that you're working with?
Yeah. So, I mean, it's an interesting time for cryptocurrency, given that we're recording this in a time of coronavirus lockdown and really significant price changes. So, I think there is the kind of broader narrative of what is crypto. Is it heading into a winter? Is it actually going to survive? Do most people that hold Bitcoin, did they seem actually bothered about the price move, and did they move into exchanges? So those are quite tactical questions, if you like, but they're the ones at least that get asked the most. And then I think there's kind of bigger questions. For example, like what's the interest rate of Bitcoin? What's the equivalent metric of the sort of GDP growth rate? Because we still don't have a framework really to explain this asset and why it's useful. It often will come down to some kind of very high blown narrative, which is just basically trying to convince people that come and get involved in this tech stock gamble. But I kind of want to give more data on actual use cases, and real valuation methods, and trying to do that both on the theoretical side and then also bringing the data to it. That's probably the bigger challenge.
So I guess where do you fall then on the, valuation line? So if the maximalists say that Bitcoin is worth every single dollar an asset in the entire world, right, like hundreds of trillions of dollars, I'm guessing you're not a maximalist, right? So where do you fall in your kind of long-term valuation and view on Bitcoin?
Yeah. So I'm not a maximalist. And I think actually of the sort of economists who end up in this space, I'm almost not the typical, I don't think that the only thing we need is hard money and so on. I kind of actually see cryptocurrencies as a really interesting alternative asset that has a set of characteristics that others don't, like a limited supply, like the fact that they're used globally, like the fact that if it is a store of value, it can then actually be used as a means of exchange in some cases, which is much more helpful than, say, your gold bar. You have to chip off a little bit to, buy some food in the apocalypse. So, it's more that like Bitcoin is a basket of very interesting properties that get fitted together. And, I think the world is in a sense, short of assets that have its characteristics, that are not correlated to what's going on in a particular country, that have a fixed monetary policy, that have some utility but can also be stored in very large amounts very safely and cheaply. And so I think, say Bitcoin particularly fits that niche. I do think, stable coins, they kind of, I think Tether looked at Bitcoin and was like, what's the one problem with it? It's the volatility. Well, let's just remove that as a property, make it stable. And that's been wildly successful. And I think, the tokenization of assets, and, the tokenization of the dollar in the terms of Tether, I think, that's not going to see loads of price appreciation, but it might change how some of the financial plumbing, as it were, is done. So I think that's the other interesting angle. Bitcoin, interesting asset, lots of cool properties. We need to see how large the world's demand for that is. But cryptocurrencies more broadly are helping out some other experimentation.
Right. I mean, especially for Tether, I mean, one of the greatest examples of why people love Tether, I think, was in the bubble of 2018. People were using Bitcoin in Russia to transfer money back to China. So Chinese people would bring their goods, import their goods into Russia. They would sell them in the markets for rubles, for cash, and then they would send their money back on either a daily basis or a weekly basis. They'd take all their cash and just convert to. Previously, it was like Bitcoin, right? And especially during the run when Bitcoin was going up 10% every single day, people would just convert to Bitcoin, send what they needed to back, and then pocket the extra. But as soon as the price direction started moving differently, and that it capped it or peaked at 20,000, they switched to Tether because here was an asset that was dollar denominated and could also be sent across borders no problem from Russia to China. And it did not have the volatility that Bitcoin had, especially when the volatility is driving price down. So I think there's huge demand for stable coins, and that it's one of the underlooked things that kind of came out of 2018 is just the insane demand for a dollar denominated, I don't want to say unregulated, but less regulated product, which can move freely between countries, especially ones like China and the United States, or China and Russia, which don't have the best relationships with the United States.
Yeah, and I think so. Almost perhaps a better way of putting it is, regulated in a different sphere of jurisdiction from the one that the underlying asset originated from. Right. I.e., dollars are regulated by the US, but the usage in this case is happening in China and Russia, which is kind of out of that sphere of jurisdiction to a large extent.
Yeah. So, I mean, do you look at Tether Flows?
Yeah, absolutely. And just going back to your point of like 2017, 2018, one of the most interesting things for me is that actually when a lot of the exchanges that were on the mainland of China were closed down, a lot of Bitcoin was actually sold for Tether, and like a lot of that Tether then moved off the mainland. And I think it's kind of one of the reasons why Tether's quite sticky, is because there was actually quite a lot of wealth transferred into it in that kind of critical period, and that formed the basis for that ecosystem. But sorry, I interrupted you.
No, I mean I go back and forth on Tether. I mean I know that it's I don't know. I mean you have to ask on the day. I mean I know that it's probably not the best, doesn't have the best foundation, and it's definitely like very again, it's like Bitcoin. It exists in this kind of regulatory arbitrage structure where it's able to grow and be used because it exists outside of the normal regulatory structure, and because of those properties, it has demand. And so when I think of it, and I think why can't it should just be shut down tomorrow? It's not that simple. And So I don't know. I mean, I go back and forth in Tether. I mean, I see its benefits, especially in emerging markets and countries that don't have the best relationship with the United States. And then I think about the other things connected with the company itself. So I don't know. I mean, so looking at Tether as an economist, I mean, what do you see?
Yeah, so I see essentially a gap in the market being filled.
Right.
The reason I think Tether's been so popular is because there was latent demand on two major fronts. One was to to have a stable pair in a trade. You don't want to always be trading pairs that are correlated with each other. So there was a need for that, but there was a restriction on fiat getting into exchanges, and there was also a benefit at the time for exchanges to remain crypto to crypto. So Tether definitely filled that need, essentially the lack of fiat on ramps and the need for a stable, leg of a trade, and then also this latent demand for sort of a dollar-like instrument in jurisdictions that didn't want to use the dollar all the time. So that's where I see the demand coming from. I do think the fascinating thing about Tether as well, though, is like its issuance and its monetary policy. And I kind of find it amazing that people are really happy to abstract away from that and just say, this is really useful. And for me, that is a sign that there's potentially even greater growth in stablecoins, because if people are willing to value it on par or sometimes worth more than an actual United States dollar, with the caveats that people have, then there must be a whole bunch of people who would be willing to use a stable coin that's got some slightly better properties.
Yeah. No, I completely agree. I mean, it's really it proves that people would like to move, or at least there is demand for a token-based privately issued dollar.
Yeah.
That doesn't exist in some account in a bank somewhere, and that tokenized dollars, right? A token structure issued by a private company has demand, and that people may pay more than par for it, right? You're completely right. And I think this is what really has driven Circle and all the other stablecoin issuers to really ramp up their operations, right? Because I think Circle looked at what Tether was doing and said, hey, that's easy money. We can do that too. And they've seen, I mean, there's been incredible growth of USDC in this past year.
Yep, that's true.
And yeah, huge. Like here's a question though, is that in my head, right, the benefit of the company that's issuing the stable coin, like USDC, right? Let's just use them for example, is that the underlying asset is a derivative of the cash balances which sit in their accounts. So when you send money to Circle takes that money and then they reinvest it into bills or bonds or something else where they can earn a yield on it. So it's when you can be an asset gatherer and collect, I don't know, a few $1 billion. If you're earning 1% to 2% on that a year in relation to the stable coin that you've issued, that's quite a lot of money. That's a great business structure.
Yep.
What happens with these stable coins if interest rates continue to go negative and it becomes harder for banks like Circle, a company like Circle to find yield, or at least enough yield to make it worthwhile for them to issue the stable coin?
Yeah, and huge question there. And I think in recent days they've come out with like public statements saying we'll be fine, but obviously those are statements, and we have to wait to see what macro environment we end up with. I mean, God, that would be the irony of it, wouldn't it? That the biggest crypto use case is undermined by expansionary monetary policy in the underlying asset. But yeah, I agree. would have to run, their fiat investments with some risk there to earn a return. It's I don't think you could treat it like a money market fund because they wouldn't make
No.
enough money to, fund the business,
Right.
especially because they'll be facing, higher regulatory and legal costs, being based in the US and so on. So, yeah, that's definitely a tough call. I mean, maybe they'll go and, lend it for the high interest rates you can get on crypto lending platforms, or go buy Bitcoin with it. But anyway, I'm kind of kidding, because they'll have some fiduciary duty not to do that, basically.
Correct. But let's say the most, let's say they can go to 30-year bonds, which we're at the moment are doing a point and a half, I think, right now, on their yield. If the 30-year bond collapses to, I don't know, 0.25 or less, it really destroys their business model. I mean, even if they're putting their money in 10-year treasuries, yeah, but the treasury is closely. I mean, I think it's going to zero at some point, and you're going to see the 2-year negative. I'm sure they can say they're going to have yield now and that they'll be able to continue, but it'll be interesting to see how it continues, right? Because there's this strange. It's strange that you can barely get a yield for your dollars in the real world, but once you move them into USDC, there's bigger demand, right? You can go to Compound or some of the other lending platforms and earn a 4% yield or a 5% yield or even higher depending on demand.
Yeah.
So I don't know. I mean, maybe it'll be interesting to see how this plays out over the next few quarters.
Yeah. But I mean, do you think that actually they could get to the point where, if you want to go buy a stablecoin from the issuer, you have to pay, $1.02, because people are clearly getting some utility out of using it, and maybe therefore they'd be willing to actually pay more, not just on the kind of open market where we do see stablecoins go above par, but actually when they go to the issuers.
Right. I mean, maybe, but the thing again, I know that with our business, the thing that's so interesting for us is that we have this one-to-one at par stablecoin that we can move freely between from our bank account into USDC without having any loss, no fees as well too. So if that changes, right, if we're paying 1% or 2%, I mean, why wouldn't we just move to something that's more competitive, like DAI, or I'm guessing DAI would still be competitive at that point, because if it's a cent or if it's like 1% or less, then it's probably better to move into that than USDC.
Yeah. And so I kind of agree. I mean, the one thing I worry about with DAI is, like, almost sort of statistically, at some point there'll be a DeFi explosion or like implosion. Something is just kind of going to go wrong at some point, because we're too early in the life cycle to have all the kinks ironed out. And so I think we need a few more cycles. And I do wonder, like, we can definitely see that, like, a lot of the DeFi contracts, they're sending, DAI to each other. So I think there's actually people who are, making loans on borrowed DAI, for example. So there's definitely some leverage happening. There's definitely some counterparty risk. And I just don't think we know how that plays out yet. I mean, it's a really interesting, like, on-chain analysis problem to be like, can we actually understand counterparty risk? Because, we have all the records of transactions, so we actually know where the assets are. We don't know exactly how they're levered up, or where sometimes we do. Could we actually create those counterparty risk models? And that might be something that kind of helps the people get a bit more comfortable with that space. But I think at the moment, if you wanted to run a really large business on it, that'd be a brave thing to do.
I mean, are you doing analytic research into what's happening in DeFi at the moment?
Like, not a huge amount. And one of the things about Chainalysis is we sort of work at quite a large scale, if that makes sense.
Mm-hmm.
We've got to, we're no longer niche. So we've got to sort of provide analysis on like all the assets and on where most of the activity is.
Yeah.
And that tends to drive you, sort of means the majority of the hours of your day are on things like, Bitcoin or Ethereum or even XRP. So like DeFi is interesting, and personally like to watch it and spend some time playing around and looking at what's happening on chain. But in terms of almost commercial focus, it's not quite at the size yet that our customers come and ask us lots of questions about it, if that makes sense.
No, I understand. It's still very nascent. I mean, they just barely broke $1 billion in assets that were locked up in DeFi. Yeah. So it's still small, extremely small in comparison to everything else. I think you're right. I mean, there's a lot of. Would it be considered hypothecation, right? Or is it just derivative leveraging? Where you have, you have the implosion, right? I mean, you talk about the implosion, but it happened the other day at the beginning of March when price collapsed. Maker, the volatility of Ethereum pushed the gas prices so high that one person was able to essentially not steal, but work the contracts in a way where he was able to get money essentially for free.
Yeah.
From people's CDPs as they were liquidated. I think you're definitely right. There is a lot of kinks to work out, and that implosion that happened last week was probably a good test for what's going to happen in the future.
And don't get me wrong, like I kind of want it to succeed. I think it's really exciting.
Yeah.
I just think there's some experiments to go through first.
Right. So can you kind of, what, from an on-chain perspective, like what happened? What was it, like 2 weeks ago, around the beginning of March, when we had that huge sell-off? Like, what were you looking at during that time period?
Yeah, so I think the key indicator whenever looking at one of these kind of really extreme periods of price volatility is just the top level metric almost is the on-chain inflows into exchanges. Mm-hmm. So for sort of the year to date, up until I think it was 9th of March, on average, you had about 52,000 Bitcoin going into exchanges every day. And then on like the 11th and 12th of March, so I think the 11th was, I think 270,000 Bitcoin in a day, and the 12th was 350,000 Bitcoin a day. So, vastly higher multiples. And most of that Bitcoin came from people that had been holding Bitcoin for like 6 to 12 months. Mm-hmm. And so, those two figures alone, if you like, tell a big story in a sense that there is, many multiples more, sell pressure coming in. And we know that Bitcoin markets are not enormously liquid. Even if you get 10,000 more Bitcoin being sold in a day, it can have a big price effect. Now imagine having 200 or 300,000 more Bitcoin being sold in a day. And that's why we saw such a huge price decline. We also saw there was an increase in the number of sort of smaller transfers on chain. So, sort of things are less than a Bitcoin, which suggests that, it's a definition, if you like, that retail is people moving less than a Bitcoin, but broadly so, though we did see an increase in those, but we also saw an increase in the number of really large transfers. And that, was the sort of more professional side of the industry selling off. And I think something that's actually really interesting is normally when you see Bitcoin going into an exchange, the price effect happens 12 to 24 hours later, because people tend not to sell all at once, right? They kind of go, okay, I've put 1,000 Bitcoin on an exchange. I'm going to, chop that up into small orders and sell it over a period of time, so I don't move the market. What happened this time is those, hundreds of thousands of Bitcoin hit exchanges, and people sold within, hours of getting it on to the exchange, so much faster. So that was a real sort of fire sale, event. But then once you get past those days, actually things have been quite a bit calmer. There's still been about 100,000 Bitcoin flowing into exchanges every day. But a lot of it's also flowing off exchanges, which suggests that there's another sort of side, taking it and then actually going, and putting it back into storage. And then, the final part of the puzzle of these last few days is, Tether then pumped hundreds of millions, I think even $1 billion worth of new Tether, which, we've kind of got our own Federal Reserve in a sense, that they provided, some extra liquidity to buy up these assets, and, that stabilized the price. And I know it fell a bit today, but things have been relatively stable since then. So my interpretation of it is, there wasn't this unprecedented inflow into exchanges. A lot of it was coming from, the recent professional holders who got into crypto. Maybe they had margin calls to meet elsewhere. Anecdotally, they weren't able to sell via OTC, so that's why they came into exchanges. But then once that selling pressure had been done, actually a lot of, the people who hold Bitcoin for longer time periods, who don't have those perhaps cash demands, they sat on the sidelines. The large percentage of Bitcoin didn't move, like the majority of Bitcoin didn't move. And, then with perhaps the extra liquidity from Tether and people calming down, Bitcoin has maintained its stability since then.
Yeah. Well, for now, right? We're still.
Oh, yeah.
Typically, I it doesn't always take, 5% of Bitcoin is always going to move the market a lot, right? Which is about how much came onto the exchanges, which what 500,000 was 500,000 BTC, which came onto the exchanges.
Yeah, sort of in excess. Yeah.
Yeah. So, that amount of Bitcoin probably could always drop the price 50%. It's, I know there's some, like the spot markets are much more liquid when compared to the derivatives markets, just in their nature of how they work. I was watching on that day just the spreads that opened up between the spot and derivatives exchanges were the most surprising to me. It's just how far everything was able to be pushed in this for a 12-hour period, where it completely collapsed, and the widening of spot versus, I guess, BitMEX in this case was just I'd never seen anything like it before.
Something that's actually interesting is there were quite large inflows into the derivatives exchanges as well. So people were sending a lot of Bitcoin there, either to hedge, or I suspect some of them were just to speculate as well.
Well, but the rates were, the rates went to 10%. It just made sense, right? But when you have these rolling margin calls, so the normal thing, right, is that if you if the rates are that far pushed out, if it's like -5, or even in this case it was -10%, you should be going long. You should be going long on the derivatives exchanges while selling spot. But that just completely starts to create this wall of rolling margin calls as the price keeps on coming down and down and down, because spot's so liquid. And then it just widens out even further. People move more money to the derivatives exchanges. And eventually, I think BitMEX had to throw in the towel, and they just turned off the exchange for 20 minutes or so to kind of let the market reset.
Crypto's version of a circuit breaker.
Yeah, it's I think Arthur was probably staring at the screen, losing some hair, and just decided that's enough. That's enough. Like, turn it off. As soon as they turned off as soon as BitMEX went down, right, the market stabilized. the price jumped
Yeah.
up $1,000 and everything kind of came back into normalcy within a 6-hour period. But in that moment, I mean, I like derivatives exchanges probably could have been pushed if he hadn't have, like, I'm just my conspiratorial tone. If he hadn't have killed the market right then in Max, the derivatives exchange's price may have been pushed down to zero. I mean, who knows how low it could have gone.
And then, is the insurance fund big enough? Starts to become a question, which it shouldn't normally be.
Right.
Yeah, I have some sympathy with that view. I mean, like, I don't know what BitMEX's motives were at that time, but I definitely like their ability to magnify the market conditions is like, I don't think crypto had experienced it to this extent and has now learned that hard lesson.
Yeah. Wait, was that? I mean, you must have been glued to your computer for that day, just watching the on-chain metrics and what was going on and the service providers, right?
Yeah, I mean, it was funny. So I sort of, I had like a good thought and a bad thought, and I was like, the good thought was, the bad thought was like, I'm the chief economist of like an asset that's just fallen 40%, and the good thought was, hey, I'm a chief economist of an asset that just fell 40%. I was like, what better time to try and understand this? And yeah, I definitely spent a lot of time, talking to people to try and explain what was going on. Like, it is fascinating when you can see all these flows in and out and you can try and form some sense of what's going on. I mean, I think things, I also have like a level of caution. If you like, there's a difference between being an economist and a trader. I'm thinking, what's almost the global implications of this? What's the impact on like the market structure? And again, do I think my data is right or wrong, rather than, where do I think the price is going to be?
Right, exactly.
But almost like, I think though that 48 hours really taught me kind of what people care about. To the extent to which you can use the on-chain data to help people make decisions in these kinds of times of stress. People find that really helpful. And like, I've gone through a lot of effort, I think, at Chainalysis, kind of going, well, what can we use this on-chain data set for beyond just, compliance and investigations? And, when the market's doing really well, people are like, I don't need any data. And crypto is amazing for the fact that it is so data rich, yet people have done so much trading and so many investment decisions basically on zero data. But then when the market suddenly went into a period of stress, I've kind of never had more people get in touch to be like saying, hey, what's going on? Can you help? So I do think, I mean, obviously hope that things go up again, but I think this has been actually the first time, if you like, that, and it's not just Chainalysis, but there are other people who've done this as well, but there's been enough data that's been clean enough, that's been well understood enough to actually provide a bit of a description of what was going on and to help people make decisions. If you go back to 2017, just none of that infrastructure existed to provide a data-driven narrative of what was happening in the market, whereas that does exist now and people are starting to notice that. And this was a really good example of that.
So outside of this, I guess, short-term volatility spike that we've seen, would you say that the fundamentals of the fundamentals of Bitcoin are strong to talk like JPal does?
Yeah, I would say they are stronger than any other crypto asset. I would say that I do. Yeah, I draw a breath and sort of pause, because I do think there are these kind of differing visions of where Bitcoin should go. There's essentially sort of, should Bitcoin be a financial asset that has widespread adoption? And then there's, should Bitcoin be this asset that can be used by anyone around the world to do, what they want without restriction? And I actually do think they are slightly competing narratives, because on the investment side, you actually need like the mainstream to get comfortable with this, and that means it needs the AML and so on, and it needs regulated exchanges that provide real data, and you need proper liquidity, and you need kind of professional custody, and you kind of need all these adult things, as it were. And that does put some pressure on the sort of libertarian side of crypto for it to be used for whatever it wants. Like they can coexist, but it definitely, the sort of let's make this a investment grade asset, means people are kind of more buttoned up, and there's more processes and there's more regulation and more compliance, essentially. So the reason why that sort of digression is, we could be entering a new kind of world after coronavirus. From an economic side, there'll be a big recession, but we've also, exploring some new paradigms in monetary and fiscal policy in the fiat world. And so it's unclear whether people will go either, okay, in a world where there's now unlimited quantitative easing, and we've seen the effect of coronavirus on national economies, I want a asset that is used globally and has a cap on it. Or they might just go, what, oil's just gone under $20. Like, that's my unconventional asset. I don't want to deal with anything new. Don't talk to me about Bitcoin right now. Like, I've got negative yields on my bonds. So I think we've kind of got those two. We don't know which world we're going to be in. And maybe that will then create more space for the sort of Bitcoin being used however people want it to be used world. So I guess I'm not being kind of particularly clear, but that's because at this point in time, there's such big uncertainty. And really, I think in 6 months' time, we will know whether the fundamentals of Bitcoin are strong or not.
I mean, if you spend too much time on crypto Twitter, I think you get given a lot of different
enough said.
narratives about the future. I guess that your point is right, or I mean, it's nuanced, right, which is better than a lot of other people's. I just get a little bit. I don't know. I mean, I've always been a trader, right? So I look at short-term prices, and it's harder for me to look at long-term, long-term growth paths. When I think the biggest models that you're seeing right now for Bitcoin are they're talking about like stock to flow, and how this is we're going to make a run to 100,000 just because the miners are receiving half of what they did before. It doesn't really make sense to me. I mean, I know that the data supports it, but on the other hand, it shouldn't be that easy to 10x your money, right?
Oh yeah, absolutely. So for me, I don't think any of the sort of fundamental valuation models that we have at the moment are particularly good. Like, the value of an asset comes down to how people use it. And the main use cases for crypto at the moment are, trading and speculation, investment, i.e. just holding and waiting to see over multiple years. And then, still a bit of criminal activity. So, perhaps also like offshore unregulated gambling, if that's how you think about derivatives. They're either, essentially a casino, or they're a way of hedging exposure to an asset. But, they're also kind of quite entertaining, is my point. And people enjoy that. So that doesn't feel like enough of a use case yet for me to say Bitcoin's going to go, to $100,000. That's why I say, actually, when you're trying to make those really long-term price forecasts, you've got to think in that narrative way, and you've got to think about what are the data points that you want to see along the way to tell you which kind of path the asset's on. But we still don't have enough use case for this to be a really big asset yet. I think it has the
Yeah.
potential, but there's, it's hard to make 10x your money for certain. There's clearly some risk around that.
Right. I mean,
I think that,
look, I know, like I know from an investment perspective, it's probably a good thing to put. Well, I mean, I have it in my portfolio. I mean, you buy Bitcoin, I buy Bitcoin. Everybody buys. Most people in crypto buy it, right? But from if you're talking to like an institutional person, you just tell them like a 1 to 2 or even a 5% or like a 2% allocation of Bitcoin into their portfolio. If they'd done it over the past couple of years, would have given them a like 5 to 8% yearly return, just by having it, and then it also reduces the volatility of their portfolio as well too. Reduces the standard deviation. When you talk about it like that to professional investment managers, I think they see it differently. I don't know. I mean, it's.
No, I agree. I agree with that. I just think the question they then have is like, so how can I go buy some? I want to put in an order for, I want to buy 1,000 Bitcoin. And you're like, well, you got to be careful because if you go do that, you can only go to these venues and you might move the price. And then they're a bit like, oh, and what if I want to exit quickly? So I actually do think there's enough investment professionals that certainly like a month ago were starting to really get that narrative that you said. And then they were starting to go, okay, so how can I actually go play, as it were? And then they were like, I can't just go and select this on like a computer screen in my current, asset portfolio. Oh, and we still haven't got over that. And I don't think the kind of crypto ecosystem covered itself in glory in the recent price decline. I mean, it had a lot of liquidity to try and chew through. But if I was an investor and I saw that, I'd be like, oh, okay, that isn't a liquid market. And I'd have some concerns.
Yeah.
But I think I'm saying, I kind of agree with you that investors are actually interested and actually they're almost asking this more detailed question. And that is encouraging.
Yeah. It's just, we'll see what happens, right? I mean, it's this new, I hate using the word paradigm, but it really is. When bond yields go to zero, or the 10-year, let's just say the 10-year goes to zero, that's a new paradigm for the US dollar. Because at that point, the treasury bond, the 10-year bond, the 10-year note, 10-year note, essentially becomes cash at that point. And like what does that do to investment structures? Like it pushes people even deeper into trying to find yield in certain places. There's always this strange choice that you have to make, where if you take out volatility from a market, it doesn't actually leave the market. You just displace it until a time period later down the road. And so, I know that Keynesian economics, or post-Keynesian, or whatever you want to call it, right, has really driven a lot of volatility out of the market. I mean, just look at the last 12 years of this market movement from 2008. It's been the lowest volatility bull market ever. But it's done through financial engineering and also through increased analytics and algo trading and other things. But at the same time, that volatility doesn't disappear; it just gets pushed down the road until something like now, when everybody's extremely over leveraged. Valuations have never been higher, and there has to be a return, right? Where you can't get away from the median for too long before valuations and the leverage to need to be reset. And maybe that's what's happening now. I mean, it's good for me. It's good for you as young people, but it's bad for our parents.
Yeah, I agree. So I mean, I was doing my undergrad when the financial crisis happened, and I've actually gone back and read a lot of the stuff that I read back then, and also thought a lot about the history of the last 10 years, because in some senses that wasn't the most fun, kind of graduating into that recession. It's like,
Yeah.
now I get to this point in my career, everything was supposed to be like, in the recovery mode, like, okay, back into a new, potential paradigm. But I also think the thing that I almost worry about is the macro, the monetary and the fiscal policy that we've had over the last 10 years actually was inched towards, very carefully and slowly. People say too slowly to be quite so expansionary. And that was because people were changing their mindsets about how to do, economic policy. But now we're sort of acting with all those lessons learned. And so, Fed dropped interest rates really fast and announced QE really fast. And there was no kind of discussion almost of what does this do in the future. And I think the reason why I kind of bring it up is because I worry that we hadn't got far enough into the future, as it were, to learn some of the consequences of the policy decisions that were made over the last 10, 12 years, but we just doubled down on them.
Yeah.
So, I guess we'll find out. So, I agree, this is not good if you're about to retire, but I have a feeling it will also come back to haunt us as young people when we are getting older.
Potentially. I mean, I just look at it as like, if your portfolio is just a mixture of bonds and stocks and equities, right? If you're doing a typical, like younger investors are told to start out with like a 90-10 investment where 90% goes to equities and then 10% goes to bonds. Then you slowly start to increase the bond yield or the bond allocation as you get older, or it's like your age minus 10 or something. There's a bunch of different things, right? I think that kind of portfolio could be really hurt by this expansionary the expansionist monetary system, which has been predicated over the past couple decades, and what we're looking forward to in the next, decade itself. But I think if you have a good mixture of both equities, bonds, and then other alternative assets like gold, like commodities, it does provide some protection. Adding gold to a portfolio has always been a great way to reduce the long-term standard deviation of that portfolio. And I don't know why people would I understand why like younger millennial investors would want to shy away from it, because they want a higher standard deviation so they can try to get larger returns in their first years, and then transition into gold maybe later on when they're want to protect the value of their portfolio. But this kind of goes into the Bitcoin thing as well too, is that up until recently, Bitcoin was an uncorrelated asset, and it was a great thing to add to your portfolio because it would reduce the volatility in the portfolio and increase the returns. But I don't know. I mean, I think as long as you have a balanced portfolio that's not just equities and bonds, but you're investing into other things like gold, like Bitcoin, like real estate, it does help protect you against the perils of inflation and the perils of this expansionist monetary policy.
Yeah. So, I mean, like a perspective I come to it from is essentially like, there were always big tail risks, or maybe they've got, and we just weren't so aware of them, or maybe they've just got bigger. And actually, before I got into working at Chainalysis, I did a lot of the economics of climate change, which is all about how tail risks essentially get fatter than people expect them to be, because the climate's changing, and that adds in more extreme events, and people's models and so on are based on them, that not happening. And I spent a lot of time talking to like big companies and government departments about how you essentially need to try and either take some more precautionary, investments to try and actually stop that happening. But also, if it does happen, you do need to think about almost holding assets or taking actions that will perform in a really wide variety of different worlds. And I think that's why your point about if you just got, equities and bonds, then we kind of know how they operate, and they operate fine in like 90% of worlds. But actually, you might end up in these other 10% at the extremes, and therefore you want something that's pretty different in those worlds. So, yeah, that would just be from that set of thinking that I did at that time. I almost feel like we're in a fairly similar situation on the macroeconomy now. So yeah, I think your advice is right, and that's how I see it.
So what, like the big question for like that bond equity split is what happens if the price of bonds, what happens if the price of bonds and equities both decline at the same time?
Yeah.
Because that has never really happened before. I mean, we've never been in an extended period where both of those assets have declined at the same time. And that would ruin a lot of, or probably most people's portfolios, because people buy bonds to hedge against equities, and they buy equities to hedge against bonds, right? I don't know. I mean, it's that kind of market we haven't experienced. I mean, maybe this is the catalyst when there's a huge reduction in global demand, and just the supply of money just explodes, right? And it has to go somewhere, and it leads to deflation. And the deflation, I mean, deflation in theory should raise interest rates, right? But apparently not.
Do you mean inflation?
No, deflation, right? I mean, deflation should raise it.
I think we're going to experience a big amount of inflation, and then you essentially increase interest rates to reduce the amount of money that's floating around, because when you increase the interest rate, people are less willing to borrow, and therefore almost the velocity of money starts to slow down. And that's how you bring it under control.
Okay, but what happens when there's a what happens when there's a global, I guess, leveling off of population? So one of the things that our, I guess, monetary structures are principled upon is increasing growth year on year on year. And you've worked with climate change before, and I guess you must have looked at population studies. There comes a point where we level off, and we just hit carrying capacity, or we just naturally level off. There's no more reason for people to have large families, and it becomes too expensive to have that many children. So we just come to an even 2-child per person, and I think it's around 10 billion or something, maybe a little bit more. But at that point, there is no global growth that happens year on year on year, and you would either have any inflation in the monetary system would lead to just inflation prices, but there wouldn't be increased demand, right? So how do you take into account these global growth dynamics into, I guess, monetary policy and interest rates?
I mean, I think the honest answer is that most economists don't. So because it's so far in the future that you essentially discount out those states of the world. I'm not saying that's a good way of doing it, actually. And I mean, this is getting a little bit sort of nerdy, but when you you have a discount rate because the future, at least in money terms, is less valuable than the present, as in I want things now, not in the future. And there's essentially a ratio between those two things. And something that should guide your discount rate is the growth rate of the economy, because as the economy grows, if you've got some stake in it, you should, get a certain amount of kind of that reward, as it were, of the productivity increase. And so you're like, I'm going to be richer in the future, and therefore it's fine for me to kind of consume more today. And so when that growth rate is higher, you'll actually discount the future a bit more. But if you're thinking about worlds with radically different growth rates, you can't, as it were, just add them all up in one mathematical model and sum them all back with the same discount rate. You actually have to value each stream separately, according to the growth rate that it has. And that can leave you with some quite different like valuations of futures scenarios that contain radically different outcomes than if you just go, I'm going to use the same discount rate for all my different futures. And if you go back 15 years ago, that wasn't thought about in economics like at all. The fact that we could actually be facing futures that, there's one where there's like GDP growth of 6%, 3%, or 0%, or minus 3%, a year. So actually, kind of like the conceptual tools for really understanding that have been relatively slow to develop. And then the other thing that people often think about is like in all long-term economic models, you're right, there is a population plateau or even decrease. And therefore, your stock of sort of fixed assets, say like housing, will probably become less valuable. But there is also baked in the assumption, essentially, that we're approaching the technological singularity. Like productivity growth will increase. So in 100 years' time, like we should reach some level of abundance. And therefore, monetary policy basically doesn't matter anymore because we're each able to kind of build our own factory for whatever we want. Now, I'm kind of being slightly glib, but that is baked into most really long-term macroeconomic modeling. And I think the thing that was so fascinating actually about thinking about it from a climate change perspective is they were like, well, there might be some scenarios where that doesn't happen, and therefore we need to think quite hard about that and try and prevent that from happening. So yeah, the short answer is people don't think about those types of issues. Like monetary policy is based on the assumption that the party keeps going until we invent some technology that allows us to pay it all off.
Right, but if
something like, sorry, go ahead.
Yeah, go ahead.
I was going to say, and that's why something like coronavirus is so like damaging, because it basically has stopped the music of the economy for 3 months, and everyone's like, almost playing musical chairs, and they're like, but there's no chairs here, and they're like, yeah, that's because the whole idea is we just kept dancing, forever. But actually, when you stop an economy, you suddenly, debt, for example, is basically a promise to pay someone back for work they've done today, and if everyone's got all those promises, then all of a sudden someone's going to ask for it to come due, and you're not able to say, oh, but I'll do some work for you now so we can like push the debt off into the future when an economy shuts down. So that, I think, is something that we've seen in the last couple of months, and we're going to see even more so in the next couple.
Yeah, I mean, it's probably the most damaging thing that can happen is that the economy shuts down, but the debt still exists, and it just keeps on piling up. People have to pay bills, but they're now unemployed, and it doesn't stop, right? I mean, there's nothing you can do to unless you're forcing the banks to give someone like a debt holiday, which I know is one thing that has been implemented on the corporate side, but not on the retail side. You haven't seen any delays of student debt or personal debt. So I don't know. I mean, I think that the next 3 to 6 months are going to be extremely. There's going to be a lot of damage that's done, and we don't even see it now. I mean, you look at the I guess global leverage that existed before the first price drop, right? Was massive, right? You're looking at valuations at like highs that have never been seen before, and so I think this is the first wave of deleveraging that's been happening, and you saw this in the crypto markets with Bitcoin being sold off to probably meet margin calls somewhere else.
Yeah,
and this probably continues, at least in my head. There hasn't been there hasn't been any major bank or fund closures during this period. You haven't seen any blowups that have affected the market, and that's why I think that we really haven't seen the worst of it yet, is because there's been some support of domestic banks and to keep them from going under. But I know there's stuff that's bubbling up, especially if oil goes we're at $20 right now, right? We just went under $20 today. What happens if oil goes to $10 for the next year for an extended period of time? Like, there is so much debt in the oil and gas space, which cannot be serviced if the price of oil is that low. And I know that the Russians came out and said that, hey, we can have $25 oil for the next 10 years. We're completely happy with that. So that actually must be very disheartening, because to see as someone who's studied climate change for so long, is that we could see a decade of low oil prices. What does that do to set back technological development of renewables and other alternative energy systems if the price of oil is that cheap?
So I think the interesting thing is that it's like, when you think about climate change, it's sort of important to break it out into like power, transport, industry, and then other emissions. In the power sector, that's actually decarbonized, quite substantially, and also crucially, oil's not used much in power generation. It used to be important because natural gas contracts used to be priced off oil contracts, but that link is now, well and truly broken. And so actually the power market kind of operates on its own logic. Now, obviously you might be like, well, if oil's at 20 or whatever, I actually don't know what the natural gas price is doing at the moment, but it'll probably be low as well, because they tend to be co-produced.
It's $1.60.
Okay. Yeah. But even so, like, there's enough momentum in the power sector for that to decarbonize. But then you've got transport, which obviously uses like most of the oil. And that's definitely a challenge. The big thing there is about the sort of the asset turnover, or the stock turnover. Essentially, whenever people go to buy a new car, what type of car do they buy? And I mean, while the oil price does matter, honestly, the biggest thing that matters is people's preferences for SUVs, more than anything else. So, that's where like Elon Musk, making like the Cybertruck or whatever, actually does more to help that than the price. Fuel costs are important in people's purchase decisions about vehicles, but they're not. There are other factors that you can kind of play with, and there might have to be greater subsidization if that's your thing in the country, the policies. But it's not like the end of the world. So, if we had gone back a decade when oil prices were really low, like in 2013 and so on, it definitely affected things. I remember working through that, but now I feel like there's enough momentum that actually, the technology costs have come down. It's less of an issue now, but it's still not helpful.
Has a life of its own, yeah.
I think so. I mean, like, that's a very sort of broad statement to make about.
Or there's enough political capital and people wanting to see these sorts of ventures and technologies succeed that it will receive funding regardless of where the oil price is.
Exactly. But back in 2012, 2013, that was not the case. And, we sort of lost 5 years because people were like, we'll come back to this, when the economy's better.
And what about Bitcoin mining, right? So this kind of ties in with global, the climate change debate as well, too, is that Bitcoin mining as a whole, and I'm going to go check this right now. So I spoke with, I forget his name. Oh, Alex DeVries from Economist, right? Who runs a website called Economist, and they essentially he has a Bitcoin energy consumption index, and he tracks the amount of energy that's being used across the entire sector. He's come up with a couple of models that calculates this. So his current numbers, it's actually declined a little bit recently, I'm sure, with the price drop. But the carbon footprint for Bitcoin is 33 megatons of CO2 a year, which is comparable to the carbon footprint of Denmark. And it consumes 69 or almost 70 terawatt hours of energy, which is comparable to Colombia. And then it also has 8.3 kilotons of e-waste generation, which is comparable to Luxembourg, annualized.
Yeah, I mean, my thoughts are that, like, it's not good for the environment. And I also think people who are saying, look, it's largely using renewables kind of don't understand that renewable electricity could be used for some other source, some other use, so it is displacing that. At the same time, humans do a lot of stuff, like stupid stuff with electricity. And so kind of why, if this is something that you can deal with within like an electricity market that's got an emissions cap, then it's absolutely fine. Like, you don't need to technology discriminate against the way that people are using their electricity. So, it's kind of like, yeah, Bitcoin uses electricity, so does a lot of other stuff. Like, literally,
it's not just the electricity. You also have the e-waste as well too, where as soon as these machines reach the end of their life cycle and they no longer can produce Bitcoin at a profitable rate, they're thrown away. They can't be recycled.
Yeah, that is true. Maybe there should actually, we should set up a fork that allows you to kind of, give an extra bit of use, life expectancy to this hardware, because, like, actually, the security that the miners generate is a valuable asset. And you're right, in Bitcoin, there's this arms race, but in the same way that, like, old buses are reused in other, countries or situations, or like, things are recycled, we could almost repurpose that, the hash rate to another coin to secure it, because there are other applications that, need decentralized transaction security, but kind of almost can't afford it on Bitcoin. I don't know. I'm kind of ad-libbing. But yeah, it's like one of the, other than maybe crypto Twitter, it's one of the least attractive parts of cryptocurrency is the environmental impact.
Yeah. So do you have trouble talking to other economists? Do they, like, you tell them, oh, hey, I'm chief economist at Chainalysis and I work with crypto every day, and do you get people that look at, like, other economists that kind of wonder why you're, working with crypto when you should be?
Yes. I think, though, like, then the way I explain it is that, it is this complete record of transactions. There are some really interesting kind of algorithm design problems. It's a fascinating kind of self-contained economy. So I think a lot of them get it from the kind of intellectual and data side. I think the other really interesting thing is if you talk to people in what's called like complex systems and in networks, they really get it, because, like, economists can get a bit hung up on often quite simple models of how the world works. But if you're like, actually, the world's really complicated, but we can talk about that in some sort of formal way and explain how, if you see, almost one set of inputs into a complex system, it might turn out to be something radically different, but at least we have a way of thinking about it. And actually, the way to think about it is to understand that each person is connected to another person. And therefore, through that, network of interactions, you might get some emergent properties. That's probably the way to think about economics in general, kind of personal opinion, but it's very hard to do because data-wise, computation-wise, modeling complex systems is really hard. But you can do that in cryptocurrency because while the data set's big, it's actually not that big. And you also have the data there, whereas you can't get individual level data for a whole economy. So actually, I do think cryptocurrency, it is pushing forward some of the, research thinking in those fields. And so when I talk to people from that perspective, they're like, oh, I get it. But yeah, you talk to sort of a standard macroeconomist and they're like, you could be doing something better with your time. I don't think so, but I've definitely heard that.
So how did you find out about, I guess it was, crypto or Bitcoin or anything? I mean, was this something you had been looking at back in your university days? Wait, no, that was too, well, I guess during your master's?
So actually, I mean, I'd always followed technology and I heard about the Silk Road, perhaps ironically for the chief economist of Chainalysis. But I just, I heard about it and I was like, I need to go check this out because this sounds like an insane idea. Like whether it's a good or bad thing, the fact that it's possible for this marketplace to exist. And so, yeah, from that, I was just kind of thought, this is a thing, that I know you don't like it, but like it changed a paradigm essentially. So that kind of got my interest got me thinking about the possibilities of it. But then I didn't spend a huge amount of time thinking about it. And then, so Jonathan Levin, who's one of the co-founders of Chainalysis, he was my intern at my previous company, and he talked about Bitcoin a lot while he was there. And then I followed up with him back in 2017 and was starting to think about moving on. And he was kind of like, well, there's this amazing data set. Do you want to come and think about it? And that actually was what drew me in.
Is there anything else that we didn't cover that you want to touch on?
No, this has been a lot of fun, actually.
That's great. Philip, thanks for doing this.
Hey, it's been a real pleasure. And yeah, all the best.
Thank you guys for tuning in. I am Sam, your esteemed host, and I want to thank you guys for tuning in. Nothing on this podcast should be taken for financial advice. You guys should do your own research and just put the time in to start talking to people like we do here. If you like what we're doing at the end of the chain, make sure to listen, subscribe, share with all your friends. We have a growing user base, and I'm really excited to see the amount of people that are listening week to week in the episodes that we're publishing here. So for everyone who supports the content that's coming here, I want to thank you, and I will see you in the next episode.